Okay, I think we'll get this started. Thanks everyone this morning, wherever you're joining us from. Welcome to the webinar hosted by Brex with Menlo Security and with Michael Tenenbaum, CFO at Brex, and David Eckstein, CFO at Menlo Security. We're going to talk about a timely topic today. Planning for 2023 is underway, and everyone is wondering how you can drive growth in a down market. So we'll share more light on that today with our two panel members. We ask that you put yourself on mute during their conversation, and we have ample time for questions afterwards. So put those in the chat, and we want to make this as engaging as possible. With that, I'm going to hand it over to you, Michael, to kick us off.
Thank you, Katya. Appreciate all of you joining today. So my name is Michael. I am the CFO at Brex. Brex is a corporate credit card and expense management solution. And I joined the company 5 years ago, and I've been the CFO since the beginning. And I am joined today by David, who's going to introduce himself as well. But from Brex's perspective, we've always really tried to offer help to our customers and be transparent about what we're doing and the best practices that we see. And so goal today is to offer kind of what we're doing at Brex and best practices that we've learned over the 5 different planning cycles that I've seen here. So I'm excited to share those with you. David?
Great. I'm David Eckstein. On a personal note, I'm thrilled to be here with you, Michael. Brex,
too kind.
You're a great friend. You're a great leader. So, I've learned a lot from you, and, happy to also share Menlo's best practices. So for background, Menlo Security is a 600-person enterprise security company. We provide something called a secure web gateway powered by an isolation cloud. The net of that is if somebody uses our security solution, they get 100% efficacy. They can't be breached. Our biggest customers include the Global 2000s, a lot of the largest, 8 out of the world's largest 10 banks, 4 to 5 largest credit card companies, and the US government. I've seen the company grow from 30 people to 600 people. Similar to Michael, I've gone through 5 planning cycles at Menlo, 3-4 planning cycles at OpenDNS. But the key thing about all these planning cycles is it's occurred during a bull market. We benefited from 12 years of a run up in the NASDAQ. And so this planning cycle has to be tailored to the new normal that we're all facing. I want to reiterate what Katya said, which is the chat is open. And so feel free to submit your questions. And after this presentation is over, Michael and I will kind of go through all the questions that you've submitted and try to be helpful to you.
Definitely. So with that, I think it's helpful to go through kind of your view, David, of the state of the market, and then we can get into actually planning and spending strategically in light of that environment.
Yeah, I'll walk through a couple of quick slides here. I think the takeaways are we've seen a 10x rise in the NASDAQ over the last 12 years. It's one of the greatest bull markets fueled by low interest rates, large consumer spending. Capital has been extremely cheap, so people have invested in growth and new initiatives, and investors have paid forward on that potential growth. We saw valuations and multiples climb to 90 times forward ARR last year. But all things that come up eventually come down, and over the last 9-10 months, we've seen a 33% decline in the NASDAQ market. Now, all declines are not equal. The Morgan Stanley index for unprofitable companies have dropped roughly 66% since the beginning of this year. Investors have pointed towards long past the profitabilities, low gross margins have been uniquely affected by this downturn. Great example of that is Twilio, which has seen a 90% market decline. And that's mainly due to the fact that they have 50-60% gross margin. So it's a really challenging time. Some companies are continuing to outperform while other companies have been hammered kind of unfairly. But there are some best practices that survive any type of market that we'd love to kind of walk you through today. So I'll handle the first box, and then Michael will expertly handle the second 2 boxes here. But I kind of called this out before. We've had a 12-year bull run. We've been incentivized to invest in growth at all costs. And some people got in over their skis. Michael?
Yeah, I think you need to remember here that what's happened is, to David's point about profitability and how margins and all of that has started to matter more. The reason is that in a rising interest rate environment, and just in a higher interest rate environment, the value of future cash flows relative to present cash flows has gone down. So it's very mathematic in the sense that, especially in technology, where a lot of the value in these companies is either can be defined as the terminal multiple or future profits way out in the future at a higher interest rate or base rate. When you're discounting those, they're worth less. And so what's happened is the world that we were in, that was amplified in 21, as David talked about, but has really been true for a lot of, certainly the whole time frame that David and I have been in these roles at our companies. Tech was the only place to get growth, and it was the only place where you could put your money and really have it make a real return. Whereas now, with rates being just the risk-free rate being at 4%, it means that the dynamics around investment are very different. And the uncertainty that we're seeing in the world, as you can see in Ukraine, with crypto, China, questions about supply chain and inflation, which are all linked to, which are all contributing to the higher interest rates, I think, or some of those are at least, but the uncertainty is just means that we have to assume for now that this world that we live in is going to be present for 23. And so when we're planning, we need to keep that in mind as we think about capital allocation and where we're going to put our limited resources, given that investors are going to be putting higher scrutiny on the decisions that we make. And so with that, I think we should move on to the actual execution of 2023 planning.
Great. So what I'll start with is normally the annual planning process begins in the August-September timeframe. It should be an iterative process where you collect feedback from a variety of different sources, including org leaders, your board, peer comps. Katya, you can click through the organization tab. And so it's a process that usually starts in August. However, you're not too late. Starting at the end of November, December totally gives you enough time, especially in this type of planning cycle where a lot of people are just going into freeze mode. And so a lot of the iterations that you normally go through have been condensed into how do we make more use of the cash that we have available. A lot of people are focusing on, okay, I have 2 years of cash, how do I stretch it to 3? Which is a totally different exercise than what did my peers spend as they walked up to an IPO? How do I stay within the guardrails of what they did? And so starting now is a great idea. You definitely have enough time to collect the feedback that you need, but you definitely need to move quickly, because one of the most important things during this time is people need a guiding light. Your employees look to you for strength, for where to invest.
You're our guiding light, David.
What'd you say?
You're our guiding light.
Oh, that's super kind. I try to be that for many. Okay, so you want to give that information to your team as soon as possible, and being transparent about the unique challenges that the entire economy is facing actually ties those employees back into your overall goals as a company. Second, and this is a super important one, a lot of people focus on quantitative. What is my model for next year? What are my top line goals? How much am I going to spend? What's my cash burn going to be? But that's actually inverted from what you should be doing. You should first start off with the qualitative. What are the new products that we want to unveil? What new markets do we want to move into? What are the key initiatives that we want to go support? So first, define the qualitative, and then move into what are the resources, the headcount, the discretionary spend, the SaaS spend that we need to go support those resources. And then you can move into the right trade-off conversation. When you start off with a quantitative conversation, you often lose sight of the things that power the business. And Michael will talk a little bit about how costs and revenue should be bifurcated.
Yeah, I think just philosophically, David, to your point, what I've seen this a lot. I think there's always an inclination, because a lot of the companies that we work at, especially companies that are not either cash flow positive or don't have enough cash to sustain the growth of the business, the reality is you do manage to fundraising. And so you do naturally say, what are the financial metrics, especially as you get to a later stage, you'll say, what are the financial metrics that we need in order to hit our fundraising goals? And that is a very real problem. We're not ignoring that, but you can't start with what is the revenue that we need to hit, or the gross profit, or the contribution margin. You need to start with what's our product roadmap, and what is the growth that we're trying to achieve. And that's kind of the number one philosophy, and you can't lose sight of that in this market, which is that you cannot cut cost to the point that you are not growing. You can't save your way to growth. You have to, we are growth companies. Ultimately, that is how we are going to be valued over the long run. And even back when I worked in private equity, there was this saying, which is growth solves a lot of problems. And that's very true. And so you have to make sure that you're investing for growth as the leader of your budgeting and financial process. You need to make growth and sort of the support of that growth paramount. But what you're doing now that's different, and what we're talking about that this cycle is different, is that you're doing that where the hurdle on returns, back to the interest rate point, is higher. And so the expectations from investors and who've given you the money in your company likely, and just from your company coffers and you as a management team, are higher now that you have a different hurdle rate, one that is higher to clear. And so you have to be that much more judicious. As David said, a lot of things, good product ideas, they can sound good, and you should evaluate those. And that's where finance really plays that important strategic role in planning. You're working with product, you're working with sales, and saying, what are the initiatives that we're going to do philosophically to drive growth? And then how is finance going to support and help us prioritize among those based on the constraints that we have? And so that does get a little bit to budgeting. And I'll talk about headcount. And I think this is something that I've learned over the years, which is that, and it's obvious, but it's worth reiterating. Headcount is the primary expense to focus on. For almost all of the companies on this call, headcount is going to be the largest expense. Most of R&D at tech companies and at similar companies is going to be related to headcount. And it's not just because it's the largest expense, it's the most difficult expense to adjust once you have it. Many companies, Brex included, have done layoffs, and those are not only unfortunate situations that are uncomfortable, but they're also a huge effort to pull off. And there's just a ton of other spend that comes along with headcount, meaning if you hire someone and you're in the office, they now need office space, they need equipment, they need to go on offsites, they need software, which David will get to. And so there's just a lot of additional spend associated with each incremental head. So you need to be really judicious about that, especially in this environment.
Yeah, and what I'll say is $1 in headcount is not actually $1. It's usually $1.40. So on top of any headcount that you might hire or lay off, you're also avoiding healthcare costs, benefit costs, 401k costs. And so as you think about forecasting for next year, it's important not to forecast on a headcount basis, but to focus more on the overall dollar basis, just given the discretionary costs that come on top of every single headcount. The second area, or the second largest spend area, is SaaS spend. And so, at Menlo Security, to overshare a bit, we have over 130 different SaaS vendors supporting Menlo. And that's through a combination of different C-level executives championing their own SaaS that they found helpful, and then being left behind with that software after that executive may have left. So it's really helpful to download the entire list of software vendors that you have. If you have an authentication layer like Okta, it's super easy to do. You go through the entire list, you next write what are the expiration dates of each of these softwares, because a lot of these software vendors require 30 or 90 days heads up in order to cancel that software. And so understanding when the renewal dates are and what the cancellation dates are super helpful. And then you map out how many users did you buy and how many users are actively using that platform. And very often we're doing this analysis right now at Menlo Security. We'll find out that we purchased 90 seats and we're only actively using 20 seats. And so then you can have a conversation about, should you right size that account to be 20 seats or 25 seats, or can you live without it? And so, it's my goal at my company to cut our SaaS spend by 25%. It's a great area of opportunity. Also, it's a lot easier to emotionally let go of software spend than to let go of headcount and resources that have committed their lives to your company. And so it's a big area of opportunity and can save you millions of dollars.
Yeah, I think, well, I agree with you. Software is less emotional. You'd be surprised. There are definitely people who get very emotional about their specific software. And I think that gets to the point that you really need just like there needs to be a process internally around headcount, there also needs to be one around software spend. And so there's obviously vendors that do that, or there's use of the corporate card or controlling the money. But as the finance department, ultimately it is your responsibility to set controls around both headcount and software spend, because a lot of people will make local optimizations and not necessarily global, for both of these expenditures. It's a classic example of someone saying, I need my own data analyst to support me because the data team doesn't do this. And maybe I'm speaking, too personally here, but point being is like that's not the way that it should work. And you need to be planning for things at the company level. You as the head of planning or as the person in charge need to help do that. And it's the same for software, right? Because otherwise you're going to have multiple duplicative softwares all around the company. And so you need some vendor procurement process, not only for expense management, but frankly also for risk management, especially as your company gets larger.
Yeah, that's an awesome point. And there are a few key takeaways I've already picked up from you on this call, but the global optimization is key versus the local optimization. At Menlo, we have 3 different sales tools that do the exact same thing. And that's because our West sales team wanted one tool, our East sales team wanted another tool, and our EMEA team wanted a totally different tool. And so that's where it goes back to figuring out what your big rocks are, either through GTD, SOAP on a page, or an OKR process, for you to understand what does the bigger picture look like. And one of the best hacks that we found at Menlo at OpenDNS is having someone dedicated to procurement, because they'll have that visibility onto that global view to understand, do we have multiple tools doing the same thing? And it's one of those roles that the ROI, is almost immediate, and they're going to bring you back so many more savings, but also streamlining processes in a way that just helps your company succeed.
Totally.
So going into the overall value analysis, as you think about 2023 planning, we created this very simplistic budget request form for you. Normally you'd seen this broken down between headcount requests, treated separately from discretionary requests. But for simplification, we just rolled it up into one sheet. But the conversation that you should be generating with your org leaders is, what new headcount do you need to go support those overall strategic goals? Great. And what is the payback? So it's not just growth at all costs anymore. It's how do we grow efficiently? And so rather than throw money or resources at unproven new projects, it's really good to agree on a timeline to get that payback. So is it a 12-month payback to open up a new office in Singapore? Is it an 18-month payback to go build a new product, market, and go sell that? And just hold yourself accountable to it and have check-ins along the way. So as long as you have that accountability from, this is the investment I need, but this is the ROI I expect to generate, you can hopefully navigate these financial markets.
Makes sense. So I think with that, it's probably good for us to talk a little bit about execution. At a high level, I know, David, you're going to go through some of these points, but as David mentioned, you have these OKRs or big rocks or things that you want to set up front. And the overall experience that I've had, which has been most valuable, is that you have to have both tops down and bottoms up. Just because, you can obviously, and we talked about this with leading with revenue versus leading with product, right? You can always come up with some dream case. And I remember back when I was at SoFi, which is before Brex, we had a banker come and we had projected these really aggressive numbers. And the banker was like, these numbers are unbelievable. And I said to my boss at the time, I was like, yeah, but we haven't hit them. And so the point is you can say whatever you want, right? But then the people at, the bottoms up has to agree that these are feasible. And I think the reverse of that is, of course, you need someone at the top pushing to make sure you're going to get to your goals. And so I'll let you, David, expand on that. But I think from my experience, you need both, because one independent of the other will not work.
Yeah. So what I'll say is it's really valuable to have an honest conversation, not just with your direct reports, but your entire company about what the future of the market's going to look like and how it's going to affect your company. So we had this conversation a couple of weeks ago at Menlo. We're doing just, awesome right now, and we're growing at a good clip, and we have 3 years of cash, and we're in a great spot, and we're super lucky. But the key there is we want to make our employees accountable, make them realize that Menlo is on a great path, and make them realize that every dollar counts along the way. And so level set with the new normal with your organization. Do it at a group of all hands, do it in your staff meetings, but make sure people understand the state of the market, because it'll change the request from, I need 100 new heads next year, to how can we do more with less? How can we reallocate our existing resources? At the end of the day, everyone in your company is probably a shareholder. And so the most important thing is to maximize the shareholder value. And in this market, getting everyone aligned on the state of the new normal will help you maximize that shareholder value. The second thing is, don't wait too long to get feedback. So, loop in your board right away. Don't wait for a perfect model that you think of every edge case before sharing with your board. Your board wants to become a trusted partner in this process. They, very similar to you, have probably never gone through this type of market before. And so they want to share the best practices from the other companies that they're working with, so that everyone kind of wins together. So loop in your board early, loop in your advisors, loop in your mentors, and make sure you take feedback from your org leaders, because they're closer to the customers, they're closer to the product, they're closer to the problems than you are. And they can tell you, well, this isn't feasible. You can't cut 10% of our customer success resources and still maintain some NPS score, still maintain our gross retention. And to Michael's amazing point, like, you can't save your way to growth. And so if you're cutting resources that are critical to customer satisfaction or net retention or organic growth, you can't cannibalize that opportunity in front of you. And then third thing, Michael kind of touched this in the beginning, but like, yes, you have a tops-down model and people have benchmarking data, but a lot of that benchmarking data is flawed right now, because the benchmarking data comes from companies during great economic times. And so you have to take all that benchmarking data with a grain of salt. That's not to say it's not irrelevant. There are really good metrics that you can pull from the benchmarking data, like certain sales rep to SC ratios, certain span of control ratios, certain recruiter to expected number of hire ratios. That's all really good, but you need to make sure that's feasible in your business. And that's where that conversation from the bottoms up really helps to make sure that you're creating a plan that is efficient, that preserves the 3 years of cash runway, and it feels like something that everyone can align around and get excited about for the future.
Yeah, I think what I have seen similar is that by getting that buy-in and getting that feedback that David mentioned, you're establishing an ownership mindset across the company. And I think the ownership mindset, in some ways, it's like a founder fantasy, right? Like, no one is gonna, especially the larger you get, you're just not gonna have employees that feel the same ownership as the founder would, as an executive team would, or as an early employee might. And so what can you do to address that, right? You can help explain to everyone how their work impacts the P&L more broadly, and how, because in general, most of us work at companies where employees have some form of ownership in either options or RSUs. And so you need to help people understand how do the financial decisions, not just expense management, right? Not just like whether they get a coffee and whether they fly Coach or Economy Plus or whatever. It's not just that, but how does the work that we do, how does the customer retention, how does the expansion of our cohort growth, how does any of the upsells that we do, how does the market or investors think about that, and what does that mean for me, and what does that mean for the stock? And so I think that that's where finance can come in. Of course, there's the blocking and tackling of expense policies and making sure that people are doing right by company resources, but it's also just a mindset issue, and talking to people as if they're owners, because they are, and helping them understand all that you do in the context of planning. And you'll find that the outcomes are going to be really different. And so it's important that you lay that foundational knowledge but frankly, all the time, but especially during planning as people are committing to goals. Transparency in general and over communication, it gets back to what David was saying around feedback, but you're similar to what I was saying with the ownership mindset. You want to be clear about why you're setting these goals and sort of what you're working towards. And usually that comes in some form of at least mid-range or long-range plan. But at a minimum, it comes in the form, as David mentioned, of like, what runway are we trying to preserve, or what financial outcome do we think we need, as well as product outcome for our next capital raise. And I think it's okay, and in fact beneficial, to be transparent about those. You don't have to be transparent about every single piece of the P&L or everyone's salaries. It doesn't need to be radical, but it can be, I think, pointing people towards these milestones helps establish that ownership mindset. And then lastly, tactically but related, is inevitably you're going to have dependencies that come up through planning. And people are going to, nobody is operating in a silo at a company of this size that are on the call today, right? There's cross-functional dependencies, and cross-functional is always where fun goes to die, because people are, doing what they can for their team and their resources, and that's just human nature. And so as people are committing to planning, and you are being transparent about these clear goals, the value in that is you can point to these goals and say, and that helps you, frankly, prioritize among the different dependencies, because every team has their goals. And within finance, you're going to be not only creating this mechanism, which can just be a Google sheet, right? My plan is this, and we need this from that team, and what do other teams need from us, and making sure that everybody has those in their plan. But also, if there are discrepancies, you as finance need to resolve those. And you're doing that with the established goals and, financial metrics that you've set out at the beginning of the process, or the big rocks, if you will. So with that, David, unless you want to add anything, I think we can move to questions.
No, let's end on that note.
All right, that sounds great. Thanks to you both. And I'm going to start us off with some questions here in the chat, but also that were pre-submitted. So one for you, David. You mentioned that it's no longer about growth at all cost. It also, profitability matters, right? But also burn matters. One question from an attendee is, how do late-stage companies balance for growth versus burn? And what is an appropriate burn rate for a payments company? Michael, probably want to chime in on that as well.
Sure.
So if you're not familiar with something called the rule of 40, it's a good kind of guiding metric. Not all companies kind of are at this level yet, and it's something that Menlo's been working towards for a couple of years now. But basically, it looks at your growth rate and it subtracts out your operating costs as a % of revenue to figure out, do you have a number that's 40 or higher? And usually late stage companies aspire to this metric. It's something that IPO candidates are certainly compared towards. So it's okay if you don't have this today, but it should be something that is certainly top of mind. Now, I think it's important to say that we've talked about efficiency and planning and how to do it right. And we've been talking about this market that we're either in or entering. And I think it's important not to over-rotate. Like, you could build a company for this market that we're entering, and then by the time that you've made all these cost adjustments, yada, 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 now we're entering a different type of market, and now your growth may have slowed down too much. And so I would say, don't over-rotate, don't build for a market recession, but there are certain things that you can do that are favorable and investor friendly in any market, which is going back to those very specific metrics about span of control, about offshoring versus onshoring. They're best practices that you can certainly look into. So rule of 40 definitely is a key metric to focus on as you approach an IPO. Being aware of your benchmarks is important. I think people will take the benchmarks for this year with a huge grain of salt, just given that board members have changed their tune from growth at all costs to grow efficiently. But eventually, when you go public in 2-3 years from now, certainly people are going to look at your growth and spend as a % of revenue relative to your peers. So Menlo Security, our peers are Zscaler, CrowdStrike, SentinelOne, Netscope. People are going to look at their relative spend and resulting growth in a comparison. And certainly you don't want to be growing slower and spending more money. You want to have the exact opposite. So be aware of your peers, but during the next 18 to 24 months, really focus in on the key metrics that will make your company attractive in any type of market.
And David, can you repeat the method name? We have one attendee.
Oh, rule of 40.
Rule of 40. Thank you so much. Michael, quick insights from you, and then we move on to the next question.
Yeah, and I think, look, rule of 40, and just to address the payments question, Cotu recently put out a rule of 200, which is a version of that. You can Google it, just like you can Google rule of 40, and there's some differences in whether it's revenue or gross profit for a couple of these. But I think the point is, most of you on the call are private companies and probably not IPOing within the next year and a half, although I don't know if anybody is, but I also, I don't mean to assume, but based on my sense of the audience, I think if you're not in compliance with these, it's, the reality is we're shifting from 2021 to a very different world. And so it's natural that, investors didn't focus on that. You might not have previously, but to David's point, I think understand why you're not, and make sure if you're out of compliance with industry benchmarks, you have a really good reason for that and a path to become in compliance with them. So whether that's rule of 40, rule of 200, or, if you want to just, different industries have different metrics, payback periods, all these sort of standard metrics that actually do work and are available publicly. You should always be considering how you compare to companies that have done it before or in your space.
That's great. Thanks so much. Another question is, how do you tactically encourage org leaders to own cost-cutting measures versus the CFO owning the process?
This is a tough question. And, it's funny because you could go to an offsite or an ESAF meeting and everyone sits around the table and it's totally aligned. Hey, we're going to cut X or we're going to freeze Y. And then everyone leaves the meeting and they expect the other org leader to basically make that contribution. But for whatever reason, their headcount or their project that they're working on should be immune to the cost-cutting measures. And it's something that we deal with all the time. I think one, just get that alignment in the room. You have to start with the alignment in the room. Everyone has to say yes or nod or give the thumbs up that this is something that they're geared towards. I also think giving that conversation about the state of the market, for those of you who haven't seen it, Sequoia published slides they sent to all their portfolio companies, just explaining what they see in the market. I think downloading that deck, sharing it with your org leaders is a great way to start and to get everyone aligned about the new normal that we're all facing. Two, it does come from the tops down. So the CEO needs to set the tone for everyone that, hey, unless there's a super exception and, define those exceptions at the beginning, hiring is paused, or we're doing a 10% reduction, or instead of hiring 100 people next year, we're only hiring 50. Let the CEO, he or she, set that standard, and then all the org leaders need to contribute to it. But I think getting in front of it is super important.
Yeah, I'd say I can be generally meaner than David. And my recommendation here would be not to rely on people's alignment, but I would actually just give budgets to people, both TCV for headcount as well as SG&A. And I think you still need to do what David's talking about for that beginning part, because there's a question of well, who's allocated what budget, and that's the alignment. But I think rather than, because I hear sometimes people during planning processes be like, oh, let's use this as a lesson for demonstrating this, or let's see if we can come to an agreement. And I think it's actually better when there is a clear budget, and people have to stick to that. So it's almost like I don't know that you necessarily need to encourage cost cutting to address the question, but instead actually just mandating a budget that works for everybody. That is a bit heavy-handed, but effective.
Sticking with you, Michael, you talked about headcount, and one question is, when we talk about payback for headcount, what's a good framework to apply here? What metrics do you typically look for?
Yeah, it's not going to work for every, there's obviously certain types of headcount that just expand with headcount. For example, people roles or accounts payable, right? There's just, as a company grows, there just becomes a larger amount of operational tasks and you need people. But there, at least for a lot of the more expensive headcount, which tends to be both engineering, product and design, and or go to market, there's usually like clear ROI. One way, if you just talk about those couple different buckets, with engineering, product and design, you're going to invest in an initiative. That initiative should move a metric, and that metric therefore should have some return associated with it. And you can sort of justify that. I'm not going to pretend that every decision at Brex is done that way, because it's absolutely not. That would be a fantasy. And if any of you are running companies that do that, I'd love, get on the webinar now. But I think the point is that when you're talking about planning and where you spend time and what initiatives you're allocating headcount against, at a minimum, you start with allocating those that are on the big rocks. Because if you have the plan set and these big rocks, you'd be shocked until you do this at how many people are working on stuff that has nothing to do with that. Again, maybe speaking too much from experience here. And then I think on the go-to-market side, and Katya, you yourself know this, right? There's questions about insourcing versus outsourcing. And there's just questions on what are expectations around marketing and sales spend. It's very easy to do this with sales typically. And David could probably talk a little bit more about that because enterprise sales is a bigger piece of his world. But even on the marketing perspective, there's campaigns that are being run, and they're always trying to move metrics, and those have implications for the P&L, and that's the payback or ROI that you're looking for. And then there's, of course, the benchmarks that you look at, whether it's 12 or 18 months payback, depending on your market and your LTV, of course.
Yeah,
that's great. And I'm going to layer on another question for you, David, as you answer that as well, because another attendee asked whether we can share a little bit about frameworks and benchmarks for ROI, particularly around hiring. You mentioned the 1.4x for expense planning, but what kind of returns do you look for on that expense?
So there are clear ROIs, as Michael was saying, and then there's amorphous returns that are really hard to measure. For example, an engineer, you can't really look at the lines of code that they write and say whether or not they're a good engineer or not a good engineer. In the sales organization, it's much easier, especially for an enterprise software company like Menlo Security. And what we do is periodically, every quarter, every 6 months, we basically pull all of the sales contribution that a sales rep has brought into the company since they started. We also pull their salary and their variable compensation that they've been paid to bring that in. And we look at, had they brought in more revenue than the cost of that sales rep? And off the bat, if the revenue is not greater than the cost, that's probably not a relationship worth continuing. And there are ways of dissecting that even more and looking at pipeline creation, expected close dates. But in the most simplistic format, a sales rep should bring in 4 to 5x the pipeline that they need to close for the year. The amount that they close should be 4x what they're essentially bringing home. And so to start at the top of the funnel, they should have 16x. But as it gets closer and closer, you want at least a 4-to-1 ratio for it to be like a healthy sales organization in the enterprise software world. And you can do that with other organizations as well, but it becomes harder and harder the further it is from the revenue creation. In the marketing world, rather than look at marketing headcount and pipeline generated via headcount, I focus more on events, on lead generation. So if we spend $100,000 on an event, what's my expectation on pipeline contribution? But then I also have a fast forward button. And 6 months later, I look at how did that pipeline progress? All pipeline is not created equally, which is why you need to set up periodic meetings with your marketing leader and do look backs to say, okay, we spent 100x, generated $1 million in pipe, but only $50,000 closed. So even though it generated so much pipe, we had a really low close rate. Why? And so the following year, when you're looking at investing in that event again, maybe the answer is we should go invest in that event that was 50,000 that only generated $50,000 in pipe, but somehow all 50,000 closed. And so that would be a higher return. So I would just say schedule periodic look backs, be really scrupulous about your marketing spend, and then measure your sales reps periodically to make sure that they're bringing in the right multiple on their overall salary and variable compensation combined.
That's great. I think we have time for 1 or 2 more questions. So I'm just going to ask you both to keep it short and sweet. Sticking with your comment, Michael, about marketing and sales. One question that has come up is, what are best practices for designing and observing sales comp and incentives? What are the indicators that tell you it's time to reassess the current system?
Yeah, I think David just gave a bunch of helpful benchmarks. What I'd add to that is, in my observation, it's healthier to have finance run or at least contribute to the sales compensation model, as well as the marketing ROI analysis. So that should generally be run by finance. And one thing that you should look at is just quota attainment. So if you're seeing that what percentage of quotas are people attaining, and if it's often well over 100% for the majority of people, it could be that things are set wrong, or as David said, if you're not meeting his 4X rule. So those are just some ways to structurally or systemically address the issue, is to have finance play a role in that, in the setting.
That sounds great. And then the last question, and I'm asking all attendees, if we can't get to your question today, we put up a slide with the email, so reach out to us. But the last question, and also to close us off, how do you think about conversion metrics and required pipeline given the macro? Probably everything is going to be a little bit harder, but also to close us out, what are you excited about for next year?
So yeah, that's a really even question, in the sense that pipeline ratios are certainly going to change. You need more pipeline going forward to close less revenue. I think 2022 was fairly insulated, at least in the enterprise software world, because a lot of the IT budgets were fixed at the start of the year, which is like prior to the market downturn. But 2023 is a new normal. And people are creating their budgets now, and they're decreasing their budgets or holding it steady, which means that new entrants will have to prove their value faster. They need to walk in with BVA exercises or ROI analyses to say, hey, you're going to get more for less by switching to our solution. And so I would say, invest in tools that articulate the value that you bring to the organization, because I think deal cycles will elongate. It'll be harder to bet on incumbents. It'll be harder to bet on new entrants. People will switch to incumbents. People will try to go to one vendor for all their needs, as opposed to multiple vendors who might charge more money. And so I would say the pipeline numbers need to go up. Conversion rates will probably go down. Now, the silver lining in that is, if people are pulling out of advertising because advertising is too expensive, that means that the rates or the costs for different advertising online or in person should drop. And so in 6-9 months from now, when people have pulled out, it will be a really good opportunity to re-enter the market. In terms of what I'm excited about for next year, I think this is a great opportunity for new companies to prove themselves, to find new value. If you look at the last downturn, 2008, 2009, that's when the likes of Box and Airbnb and Coinbase were all founded, and Uber. And so I think there are a lot more Ubers, Airbnbs out there that are just getting their footing right now. And there are all these new industries that didn't exist during the last recession. So I'm excited to press the fast forward button 5 years from now, and then say, okay, all these companies had their roots in the 2022 to 2023 recession.
Helpful. I think more these kind of environments, at least for the finance professionals on the call, or finance enthusiasts, if you're neither of those, probably the wrong call to be on. I think this is the time where there's always a long finance wish list, and you're never going to get everything on your wish list if you're any department, because then you'd be the CEO. But I think, and even that person doesn't get all their wish list. But I think this is the time where finance professionals really stand out in terms of their ability to help their companies navigate more challenging times and help implement the strategies and the processes and the controls that they may have wanted to do for a long time. Finance is typically also the senior person most responsible for risk management at the company. And so this is the moment where we can shine and show our worth and help guide the companies to the more prosperous and greater future that David is referencing. So really appreciate all the time from all of you today. You have our email addresses. Feel free to reach out if you have more questions.
Thank you.
Thank you. This concludes the webinar. We will be sharing a recording with attendees. Thanks for joining us, and have a wonderful rest of the day.